Now that we have a firm grasp on market structure and identifying and understanding trending markets and how they create higher highs and higher lows for bullish trends and lower lows and lower highs for bearish trends, we can now move on to the three different types of structure and what they represent when we're building our overall picture of structure. In the previous videos, we were mentioning market structure in the example of higher highs and higher lows for a bull trend. We were referring to swing structure, and what swing structure is the larger structural ranges that are created when price is trending, whether that's making higher highs and higher lows or lower lows and lower highs. We use swing structure as the basis of understanding our overall trend when we're looking at analyzing any financial market. And when we're looking at that swing structure, that's where we get the large impulses or expansions to the upside or downside, followed by some sort of correction or complex pullback before we end up breaking the previous swing high or previous swing low in a bear trend. And ultimately, what swing structure is going to allow us to do, especially from a higher time frame perspective, is it's going to give us an overall bias, an overall structure to work with in understanding where price is likely to go. Now we can move on to what substructure is, and I had mentioned briefly what substructure was in the previous videos, but more specifically what substructure is it's the corrective structure within the overall swing range. So as we can see, our swing range is between this low and this high, and any price action that happens within the low and the high of the swing structure would be considered substructure. And more specifically, the corrective price action that we're seeing, the counter trend. So in this case, because we're in, say, a bull trend, we had already made a previous high, we broke that high, we've pulled back, and now we've created a new high. We're expecting some sort of higher low to form before we run the previous higher high to create a new higher high. And as a result, we need to put in some sort of downward price action. So in order to make that higher low, we need price to correctively move counter trend. So in this case, downwards. And the formation of that, the structure that is created, is called substructure. And as we can see, our swing structure is bullish, but our substructure is bearish. So the swing structure, we're creating higher highs and higher lows, and the substructure contained within the swing structure of this low and this high is creating lower lows, lower highs, lower lows, lower highs, lower lows. And we're able to understand substructure and plan out where we would expect a reasonable pullback. And we use substructure to create the understanding that we know that when price creates, say, a higher high, more than likely what price is then going to do is going to retrace or correct in a counter trend fashion to put in a higher low. Once the higher low has been established, price will then continue moving to the upside and eventually break the previous high point. So what we can do with the substructure is begin to develop ideas of where price is likely to react off of putting in that higher low and then continuing to the upside. Now, there will be a few different areas or a few different situations that we can use substructure to understand where price is likely to react. So in a bull trend, if there was a demand zone within the swing structure leg that we're caught in currently, more than likely that would be a reaction point for a higher low to form. Another option or area that price could see a higher low form and the continuation of the trend is if liquidity is created and then swept by a higher low and then continuing to the upside. We can have the combination of liquidity being swept and a demand zone being tapped into to continue the trend. And what we can have is the combination of all that, the sweep of liquidity, the reaction of the demand zone, and then a supply and demand zone flip that we could look to enter on. Now, of course, we haven't actually discussed supply and demand zone flips or liquidity concepts as of yet, so don't stress too much about that. We will be getting into that in future videos, but those are the main things we would be looking for as substructures being created. We're trying to gauge the impulsive leg of the swing structure to figure out where price is likely to react off of to put in that higher low and then continue to the upside if the trend is to remain bullish and put in a new higher high. So once we've established substructure, we can see that price is trading within this range of this swing low and this swing high. Price begins to correctively move to the downside, which is known as our substructure. Once we see a change of character, so we were creating lower lows and lower highs. Once that paradigm shifts and we start to put in higher highs and higher lows, we're able to conclude that a change of character has begun. We've switched from bearish substructure to bullish minor structure. And the minor structure is, in essence, the pro-trend structure that's contained within the swing structure. So again, all of this price action that's happening between the swing high and the swing low is what we would call a complex pullback, and we're able to delineate the two different groupings of structure within the impulsive range of the swing structure as substructure for the counter trend pullback and minor structure as the pro trend move that hasn't quite broken the high as of yet, but we're starting to see that shift in order flow. We're starting to see that shift in the overall structure. So we're able to use minor structure to gauge that change of character and start to understand that we were putting in lower lows and lower highs within the swing range, and we're now starting to put in higher highs and higher lows. So again, like I said with substructure, we can use that to gauge where a higher low is going to form by looking for demand zones, sweeps of liquidity, the combination of demand zones and sweeps of liquidity, as well as supply and demand zone flip zones. And then we can take that a step further with the minor structures. Now that we've seen a reaction point, we're starting to see a change of character. We can start to look at price moving to the upside. And this is where we can start to look at continuation type trades. So when we're looking at swing structure, we're under the understanding that we're creating higher highs and higher lows. We know that when we create a higher high, we're expecting a pullback. And if the trend is to remain bullish, we would expect a new higher high that takes out the previous higher high. So then when we're looking at price action in that corrective phase, which is counter trend that's forming our new higher low that we're anticipating, we can use substructure to understand what's happening there, to then look at the impulsive leg to determine where a demand zone has been created, or if a demand zone doesn't exist or price reacts off of, say, a sweep of liquidity, then we can start to look for potential entries. Now, of course, if we didn't want to look for entries at that point because we didn't have enough confirmation, but we don't necessarily have to look for entries at that particular point, at that higher low. We don't have to be the first ones into a trade. We can wait for additional confirmation. So once we get that actual change of character, we were going from lower lows to lower highs, and now we're starting to switch. We created a new higher high after breaking this lower high. We have that change of character. We're starting to develop minor structure. And once we get that minor structure, we can start to look for entries to look at attacking at least the previous swing high and continuing to make a new higher high if the trend is to remain bullish. And the same would be said for a bearish trend where we have an impulsive swing structure. We have our swing low, we have our swing high. Price would be making a series of higher highs and higher lows substructure. And then once we break a piece of substructure where we violated this higher low, we have now created a lower low. We're now starting to see minor structure playing out. And then once we break the lower low of the swing structure, we can see that price is continuing on in that overall bearish trend. Now, one other thing to note is looking at substructure and minor structure is not going to be an end-all be-all. It's just to create a framework and an understanding of what is happening between the swing structure, what is happening when we're putting in a higher low or a lower high, depending on a bull trend or a bear trend. What we may see is an impulsive move to the upside. We might see price correcting, creating substructure. We see that change of character. We might even get a new higher high, and we're starting to look for entries. And then price could continue down, creating more substructure, and then continuing to the upside and actually breaking the high. Because as we said in the previous market structure videos, as long as this low is not violated, we're still in a bull trend. Price can range all throughout this entire impulsive leg of the swing structure and still continue and break the high to be valid. So although we had our change of character right here, we're starting to see minor structure playing out. What we can see is then we had another change of character creating lower lows and lower highs. So we're creating lower lows and lower highs. Then we started creating higher highs and higher lows. So we had substructure here, we have minor structure here, and then we switch back creating lower lows and lower highs. So we switch back to substructure, and then we start creating higher highs and higher lows. We get our change of character right here, and then we eventually do break the swing high. And this is something that you will see on the charts, and at the end of the day, you're not going to get it 100% right. The markets are moving in the way that they do. They're collecting orders, structures being created, whether it be swing structure, substructure, and minor structure. Again, we can create substructure, start creating minor structure, and then create more substructure. And we'll be able to touch on this a lot more once we jump into the liquidity segment. And we'll discuss in the liquidity section how we can filter out, or at least have a better edge on when substructure is being created, it switches to minor structure, but then switches back to substructure and then minor structure before we actually break the swing high. Like I said, a couple different things that we would use with when substructure is being created is looking for demand zones. What might happen is we have demand zone at a lower point. We're building liquidity and price needs to switch back to substructure to actually come down. But in order to do that, we needed to create liquidity. Again, I'm speaking a little bit out of turn in terms of liquidity. We're going to dive into liquidity in so much detail in the next section, so stay tuned for that. But until then, this is just to get your mind thinking as you're navigating the charts, as you're looking at these three different types of structure. So again, swing structure is going to be your key structure in identifying your overall trending market structure that you'll be following. The substructure is the counter trend structure within that swing range between, in this example, the higher high and the higher low. So the substructure is going to form our higher low in a bull trend or a lower high in a bear trend. And then finally, the minor structure is the pro swing trend structure, which is looking to run the weak swing structures, whether it be the higher high or the lower low, depending if it's a bull trend or a bear trend. And one final thing to note, just to be able to clearly delineate the difference between substructure and minor structure, is substructure ends and minor structure begins when there is a change of character in price. So again, with a bullish example, substructure is creating lower lows and lower highs. A change of character happens, creating a new higher high, so it violates the previous lower high that was being printed, and then we start to see a shift in creating higher highs and higher lows. So once we see that initial change of character, that's when we're starting to create minor structure, as seen in this graphic right here. So what I recommend now is taking a look at your charts, especially the ones that you would have mapped out in the market structure example of the course. Start identifying your swing structures, start identifying substructure, minor structure, and really understanding the difference between the two, and begin to get more comfortable with the idea of what substructure represents on a chart when it switches to minor, and how we can look to anticipate, say, a previous swing high being taken out to form a new higher high by using the concept of where the substructure is, and then once it switches to minor structure. And then one other thing that you can also do is start looking at your swing structure legs and start mapping out your demand zones and seeing how demand zones in a bull trend, for instance, line up with your substructure in terms of where price reacts off of, and being able to start identifying when a demand zone is likely to get facilitated. Because what you might find is there might be a few different demand zones within the impulsive range, and it's all about understanding the substructure initially as price is continuing to correct to the downside in a bull trend. And again, you can look to enter on any of these demand zones if you wish, but looking for extra confluence, price tapping into a demand zone and seeing that change of character is going to give you the best insight in terms of framing up and building a trade. But again, that's what I recommend doing, is just mapping out your swing structure, mapping out the substructure, mapping out the minor structure, and just getting comfortable with understanding what's happening between these swing points, this low and this high, when price is seemingly moving in between with not breaking structure. Because if not, what we're likely to be doing is just waiting for price to do something, and we're going to be guessing at which demand zones to pick, or guessing where price is on a chart to make an informed trading decision. This way, if we're more in line with what's happening on these three different types of structure, we can make better decisions and then build better quality trade decisions and just understand order flow at a higher level, because it's so important to understand these concepts, apply them to the charts, because at the end of the day, understanding your swing structure is going to give you your trend. Understanding your substructure is going to allow you to know where likely turning points are bound to happen, and then minor structure is going to allow you to see that continuation of the trend that would, in theory, allow price to, in this case, run the previous swing high to form a new higher high.